This video aims to help you gain a better understanding of the relationship between risk, return, and volatility. To keep things simple, we'll only be talking about investing in funds rather than investing in specific companies. It will also offer some useful pointers to help you understand your attitude towards risk and hopefully to help you make better investment decisions. Welcome back to another episode of Ark Lifestyle. Subscribe to the channel so you never miss any of our latest and greatest videos as soon as they're released. In this video, we're going to be taking a look at the relationship between risk and return. Let's get started. You may not think about risk regularly, but you take hundreds of risks every day. Driving a car, stepping into the shower, choosing what to eat. In most instances, there are calculated risks. You've assessed the situation, weighed up your options, and decided the risk is worth taking. It's only when things go wrong that the risks you take become significant. Risk should be calculated, assessed, and understood. Investors tend to judge the success of their investments by the returns they make, but the return tells only half the story. Risk is as important as any other aspect of making an investment decision. In fact, it's arguably the most important aspect. Everyone's view of risk is different. An investment that appears low risk to one individual may be considered high risk by someone else. So before you make any investment decisions, it's important that you understand the relationship between risk, return, and volatility, recognize the potential impact that risk could have on your current and future investments, discuss your attitude towards risk and return requirements with your financial advisor. Ignoring risk when making investments can prove costly. Understanding the risk of an investment is as important as understanding the possible returns. There's an intrinsic link between risk and return in everything that you do. Investing is no different. How to define risk? The concept of risk has many different definitions, but to keep things simple, it makes sense to think about investment risk in three ways. Number one, you could lose some or all of your investment. When you invest, you hope that it will increase in value and one day be sold for a profit, but there's no guarantee. There's always a possibility that you end up losing part or all of your investment. Even if your investment grows in value, there's no guarantee it will perform to your expectations. You can't rely on an investment's past performance to be repeated in the future. Number two, your investment may be worth less in the future. It's also worth remembering that inflation, the rising cost of everyday goods and services, can erode the value of an investment over time. For example, if investment returns 1.5% every year, but annual inflation rises at 2%, the money invested will be worth less when you look to spend it. This inflation risk has become more of a concern in recent years, as very low interest rates have reduced returns available through cash savings accounts. Number three, your investment journey may be uncomfortable. Investments can be volatile, and the riskier the investment, the more unpredictable its return is likely to be. Alternatively, taking fewer risks should make your journey more comfortable, but could mean it takes much longer to reach your destination. The relationship between risk and return. The aim of an investment is to deliver returns. You need your investments to deliver sufficient returns in order to achieve your long-term goals. But this means taking some necessary risks to get there. Risk and return go together. You can't have a sensible discussion about investing without talking about risk. And while everyone would like their investments to deliver the best possible returns, those returns shouldn't come at any price. If an investment promises high returns without mentioning the risks it intends to take with your money, then it's definitely too good to be true. Choosing higher or lower risk investments. One of the fundamental principles of investing is that higher risk investments should, in theory, lead to higher rewards, but there are no guarantees. Investments that offer the potential for higher returns also come with a greater possibility that the investment will fail to meet expectations or fall in value. At the other end of the risk spectrum, an investment that takes as little risk as possible, such as putting your money in a cash savings account, will not deliver much of a return, and this low return may not even keep up with inflation. The amount of risk you're prepared to take is really a matter of personal choice. There's no one-size-fits-all approach. Some people want to take very little risk because their priority is to not lose money. Others are prepared to take greater risks with their money if it means the possibility of achieving much higher returns. However, most people sit somewhere between the two extremes, prepared to take some risk with their money, but willing to sacrifice the potential for higher returns by investing in ways that make them less likely to suffer capital losses. Therefore, assembling the right combination of investments to meet these different requirements and building portfolios that are designed to achieve the best return for the required level of risk is hugely important. Finding out your own attitude towards risk is one of the first steps towards successful investing. Your financial advisor will be able to help you with this. Volatility explained. Understanding volatility is vital when it comes to choosing the right investments, but volatility doesn't usually get discussed in depth. Volatility is a way to calculate the risk of a particular investment over a set period of time. A highly volatile investment is likely to experience more frequent and possibly large upward and downward movements in price than an investment with low volatility. Measuring volatility. The most common way to measure volatility is through standard deviation. This measures how much the returns of an investment move away or deviate from its average returns. More volatile investments deviate further and more frequently from their average. Volatility is shown as a percentage in the same way as investment returns are shown. Let's say an investment has a historical annualized volatility of 10% and has achieved an average annual return of 7% over the last 10 years. These numbers tell us that over the last 10 years, for just over 2/3 of the time, the range of returns has been between 17% and -3%. A variance of plus or minus 10% over the average return. For the other third of the time, the returns were outside this range. Managing volatility. Fund managers can use their predictions of the volatility of different sorts of investments when constructing portfolios to target certain levels of risk. This is known as risk targeting, and while it's impossible to predict exactly what the return and volatility of an investment will be in the future, this approach makes it more likely that a portfolio of investments will perform as expected. However, most funds don't primarily focus on managing volatility. Instead, they tend to look to maximize returns from the assets they invest in. This typically means trying to beat the benchmark within the sector in which they operate. As a consequence, the amount of risk within funds can vary wildly, and their volatility is very difficult to predict, even for funds in the same sector. With your financial advisor's help, you can find the answers to the questions that will help you to determine the right investment to suit you. Diversification is important. You've probably heard the saying, "Don't put all your eggs in one basket." In the investment world, this phrase is summed up in one word: diversification. No professional investment manager, no matter how experienced or gifted, can predict exactly which investments will perform well in any given year. So it makes sense to diversify or spread your money across several investments as broadly as possible, preferably across different assets, investment types, sectors, and geographical regions. And with that, we've reached the end of this video all about the relationship between risk and return. What have you learned about the relationship between risk and return in today's video? Get involved and let us know in the comments section down below. If you enjoyed this episode and found it helpful and interesting, remember to leave a thumbs up before you leave. Also, subscribe to Ark Lifestyle and click the notification bell so you're always up to date with our latest releases. As always, thanks for stopping by and watching. See you again soon in the next one.